Welcome to our New Year's edition of the Stearns Financial Live Chat. I am joined today by Glenn Joyce and Dax Dixon on our investment committee. And we're going to be talking about our 10 highest conviction predictions for 2021. There have certainly been some tumultuous events as we kicked off the new year just this week. And we'll get into a little bit of the impact of the Georgia elections and then some of the other things that have been happening that may impact investment markets or the economy. As we kick this off, we recognize that a lot of people are concerned about the stability of the markets, and it is remarkable in some respects that the markets have been stable lately despite political uncertainty, despite the surge in COVID cases. And again, a lot of that comes back to the markets looking ahead, generally 6 to 9 to 12 months or even longer, unless they're having a panic attack, in which case they're kind of looking at the tornado that may be above us right now. But at this point, most of them are looking ahead and thinking about the COVID endgame and the COVID postgame scenarios. And we're going to cover some of that today. So let's get started on our slides. Next slide, please. So we've been talking for some time now, in the last few years, about sailing in uncharted waters. Some of you may feel like we have gone even deeper into uncharted waters. And to a certain extent, that's true, although I think, again, we'll present some information today that perhaps grounds that a little bit better. And the techno-industrial revolution, no question that took center stage for the last 9 months, actually you could say for the last number of years, as those larger tech stocks and large growth stocks took over the markets effectively. And we have some fascinating research on that we're going to share. And so lately that trend has cooled a bit. And so the question is, what's ahead for the rest of the markets and what's ahead for tech and biotech? Because they are still going to be important in the future, even if they have cooled off from some of the pandemic frenzy. So let's go to our first prediction. COVID-19 will be under control in the last half of 2021. We would hope that it would be under control sooner than that. But right now we're hearing from a lot of our network folks, hospitals, healthcare administration, virologists, et cetera, who are saying that the rollout has been a bit clunky state by state and region by region of the vaccines. And so there are a number of slowdowns that have happened. They seem to be getting fixed on the fly. Again, the remarkable thing is that we have 3 viable vaccines now to consider. And so a lot of our network resources suggest that the combination of those who already had COVID-19 and have the antibodies and those who will be vaccinated, that we may get to the 70% tipping point by mid-year. That's the point that most people think that the amount of infection, the transmission starts really plummeting. And again, our hope is that maybe some of that happens a little bit sooner. And as we've been saying right along, we expect some significant bumps and setbacks along the way here, because this is historic in terms of not only how quickly these were developed, but the rollout of them and the size and magnitude, both here in the United States and around the world. Next slide. So, Glenn, Dax, walk us through a few of these slides.
Well, Dennis, this first one, I think when you talk about the seasonal flu, what we're used to, and millions of people are impacted each year just by, this ongoing seasonal flu. we think about, kind of what can we learn here as we look forward to the COVID-19 vaccines, and just the effectiveness here in the real world is not as good as we would like. It's around 40 to 60% range. You can see with the mean being right around 40%. And when you think about it, each year we're trying to predict, what strains, what viruses are coming. And so, it's a little bit more of an issue here where we just haven't seen the effectiveness as much as we would like. But let's transition to the next slide, and we'll look at kind of what we're seeing as far as the distribution on the COVID-19 slide. Here, this is more of a distribution, and you got to kind of follow the color coding here a little bit. So what we're looking at is distribution of COVID-19 vaccines and kind of what we're thinking about as we go forward into this year. And right now we've got two that are a little further along in terms of approved, and that's the Pfizer and the Moderna vaccines. And so what we're thinking about in terms of when would be a point where we feel like we're getting to that herd immunity where we can kind of get through this and it will no longer be a big economic issue. So let's look at the green section of the chart, and that's going through the second quarter of 2021, so really getting through 6/30 of 2021. And what that's saying is what these two makers are projecting in terms of dosages and how much they can get out there to the public. We're thinking that close to 60%, at least by this graph, can be covered. At least doses can be out there, and people can be at least feeling good about getting them. Now, I think the one area that may be underreported is people that already have it and or maybe have it and don't know they have it. That could be 15, 20% of the population already. So I think it gets back to, we're going to be hopefully, and once again, we don't know how this is going to play out. There's going to be obviously things on distribution, it may be surprises. But if you look at the tan area, by the third quarter of 2021, we're hoping we are at that herd immunity level where it isn't an economic issue for us. So we're going to have to see how this plays out, but that's at least the projections right now. Dax, do you have any other thoughts, or Dennis?
Yeah, I think that, looking at the herd immunity numbers, as you referenced, Glenn, we're not quite sure what that would be for COVID at this point. I think most predict, 66 to 70, 80% of people would need to be vaccinated to hit that number. I think, looking at some of the research that we follow, we believe that by the end of the year, something like 11 billion doses of the vaccine will be available, mostly within the developed economy. So our ability to distribute that vaccine effectively throughout the year is going to really drive how quickly we can reopen and normalize the economy. And then, since the developed economies are producing excess vaccines, we'll be able to then transition to vaccinating the emerging markets as well. So with that said, I'll transition back to you, Dennis, to talk about the number 2 highest conviction idea.
Thank you. So number 2 prediction for 2021 is that the aftermath of the pandemic, even at level 3, and what that means is you've seen references in some of our chats to the fact that our subject matter experts in this area have been saying that this COVID-19 has been a level 3 on a 5 scale. Thank goodness it did not have a 4 or a 5, the death rates, for example, of the 1918 pandemic, because we'd be in a completely different situation. So even at level 3, there are a lot of lingering effects from the pandemic. Healthcare has been stressed to the max. Many of our clients in healthcare have been stressed to the max. But it's also been turbocharged by the pandemic. And so, every week we hear about new advancements in healthcare research in a non-COVID area as a result of lessons learned in the pandemic. And so you may recall we talked early on in the pandemic about all the things that came out of the Civil War that were advancements in healthcare. Well, it's happening again, and it's actually happening at a pretty intense level. This issue of millions of workers needing job retraining, that was going to happen anyway. We've had numerous live chats and written chats and special reports on the effect of the techno-industrial revolution, just changing the nature of jobs, but all that's been accelerated. So we are hopeful that the new administration this year and Congress can help in those areas. But, we've been hearing from corporations all over the country that they are really doing a lot more in this area, regardless of whether the government comes in and helps out. And then education, just, the fact that McKinsey and others have been predicting that there's been a setback for the average student of 6 months of education, that virtual learning didn't quite cut it for a lot of students, and that for lower income students, that setback could be as much as 10 months. Good news is some of the clients we have who are in child development say, well, kids are resilient and they'll catch up, but that's a tough catch up that they're going to have to do in presumably the latter half of 2021 and 2022. So talk to us about house calls coming to healthcare.
I'll take the lead on this one. I think, what's been interesting out of this pandemic is people are just much more informed about their health, I think, in terms of just being aware of hygiene and just being more cognizant, I think. And so we've seen some trends developing. One is more from the monitoring, and people have watches that monitor their health, they monitor their sleep patterns. And so I think, especially when you think about these chronic conditions and you think about just what we want to do in terms of making sure we're protecting issues around diabetes, cardiovascular risk. You want to stay on top of those trends. And so it's very positive from that front that we're seeing monitoring devices that are coming on. Now, some people may be a little concerned about the frequency there and maybe health concerns with maybe EMFs or some of these electromagnetic frequencies. That'll probably be something we'll have to see longer term how that plays out. But the monitoring is very good, especially if you have an acute condition and you can stay on top of it. And then just telemedicine, there's been strong growth there as well. And people are wanting to be able to tap in from the safety of their home and kind of get able to get diagnosis and talk to a doctor. And so it's some very, very strong trends we're seeing with the growth. And I think ultimately it's going to be a very good thing. So I think we're very encouraged by healthcare trends. And maybe Dax, Dennis, you got any other thoughts you want to add?
Well, and just a reminder for those of you who didn't see our live chats on healthcare earlier this year, we had some really incredible subject matter experts just talking about the telemedicine area and the acceleration of that as a result of the pandemic. And so what ended up happening is that now many of those telemedicine things are reimbursable by Medicare. Or by insurance companies. And so that has just really turbocharged that area. Now, there still remains the great debate. We hear that debate on a regular basis from our healthcare practitioners. Some of them think the combination of human and technology is powerful. Others believe technology will not be the solution and there needs to be more the human touch. And so that debate we think will continue for, maybe forever, but for a while here.
But Des, I think, well, I was last one last comment there. I think just the customization and the individual aspect, we talked about that in the past in terms of just making it more individual in terms of the output to you as a consumer. And I think that's going to obviously pay big dividends to folks, as each one of us is very unique in our health needs.
Right.
Yeah.
So that gets us to prediction number 3, that corporate earnings should rebound well in 2021 and stock prices to advance modestly. So you could argue that, again, the stock market looking ahead is already pricing in some of these earnings rebounds. And so that's why the current valuation levels, we think that stock advances will be a little bit more modest, although we don't rule out the possibility of a pandemic frenzy, except in this case, it's the ending of the pandemic, people becoming very upbeat and positive and willing to pay more than perhaps maybe they ought to be for certain stocks. And so the possibility of a melt up, and I think we've already had a little bit of that, still exists out there. So bullet number 1 and number 2 may offset each other. The digital pivot We have heard from some very good sources that companies, both private and public, doing the digital pivot during the pandemic has increased free cash flow by 10 to 20%, in some cases even more than that. That's the good news. The not so good news is that now that we see the Georgia election chance for corporate tax changes in 2021, those tax changes, you may recall some of those scenarios that we ran about 6 months ago in some of our written chats. Those scenarios probably would take 10 to 12% off of free cash flow as a result of increased taxes for certain companies. So there may be a little bit of an offset effect between number one and number two. And we go back to some of the technology companies have a big bullseye on their back when it comes to tax changes. Amazon comes to mind. They have been able to manage their tax rates to well below 10% as a result of a variety of things they do. Some of them are legitimate types of things. Others you might want to call loopholes, whatever. Some of that may be changing. But Amazon's still going to probably do pretty well, at least the company. Now the stock is a different matter. Third bullet point is still huge, low interest rates. And that remains a benefit as companies finance their future growth. It remains huge in terms of investors thinking about what are my options other than stocks. And that then gets you into the next bullet point about many companies, including banks. We just had the Federal Reserve give the green light to banks to be able to buy back more of their stock. So the Fed believes that the banks are sufficiently healthy to do that. And just a reminder, those criteria that were set up to determine healthiness were after the Great Recession of 08-09. They are tough benchmarks to reach. They are not normal benchmarks. So I think that should help people breathe a little easier when it comes to the banking system in our country and how they have survived this. But the stock buyout piece, that's been an important part of returns in the stock market in the last decade. And so having that resume is, again, a good wind at the back for stocks going forward. And so one of the things that we remind in this last bullet is that these catch-up periods of earnings, where stocks have sprinted ahead in anticipation of higher earnings, and then those earnings are playing catch-up, tend to be pretty darn volatile. And so, again, this is sort of a sub-prediction of corporate earnings rebounding well, that we may see a lot more volatility in 2021 in the stock market. Now, you might say, well, wait a minute, it seems like March was pretty volatile on the downside, and it seems like the latter part of the year was pretty volatile on the upside. So yes, 2020 was pretty volatile as well. But the types of things we may see may not be as huge. They may not be big downdrafts and big updrafts. They may be more nuanced, 5 or 10% at a time types of moves, which again is typical. In fact, history tells us that generally those 5 or 10% corrections happen a couple times a year at least. And it's just part of being a stock investor. So let's go to the next slide. Corporate profits. Tell us about corporate profits.
Yeah, thanks, Dennis. And I think that you hit the nail on the head. There's a lot of, factors within the market and the economic environment that are going to be conducive to growth and earnings throughout the economy, whether that's in the public sphere, the private sphere. But we always got to be mindful of where, the market typically is going to run out in front of that a little bit. And we certainly saw the first light of the quote unquote reopening trade in March, or not March, but in November and December. But we have seen some volatility that so far this year. And I think there is going to be pockets of that moving forward. And so you could see here that, on the far right, those are forward-looking earnings expectations on the S&P 500 in the light blue. And so as the economy reopens, we're seeing a broader return to normalization throughout the various sectors within the S&P 500. Whereas, over the summer, the strongest earning companies were those companies that did benefit from the stay-at-home economy, whether that's over-the-top streaming services, cloud computing, et cetera. However, you're starting to see companies looking forward to reopening, and the expectations are there within the market, within forecasters' expectations. And I think a lot of the lessons learned throughout the COVID pandemic are going to be borne out in 2021 and beyond, as we've seen those accelerating trends. So with that, I'll move it back to you, Dennis, to talk about the number 4 highest conviction idea.
So again, some of this that we just talked about does lead into the fact that we think that U.S. large companies will putter along, technical term in the investment industry, to basically mean doing okay, but not doing great on general, while smaller companies will rebound faster, and that's after lagging for a number of years, small versus large. So again, stretched valuations in many U.S. large stocks will limit some of the returns over the next year and over the next 5 years. Value stocks, which a lot of those are more post-COVID themes, will be competitive again with growth stocks, which were the pandemic frenzy themes. And but again, everybody remembers that pre-pandemic, growth was still beating value on a regular basis. And this was a dilemma for a lot of people, particularly approaching retirement or in retirement. The old maxim was that a retiree should have 85% of their stocks in value stocks. Fortunately, we did not follow that maxim at Stearns Financial, but had that been the case, it would have been a real struggle over the last not just year, but several years. And so again, we think that there's some balance between the growth and the value side. And again, it's going to be a very uneven playing field, even for the growth stocks. So some are going to grow into their stretched price earnings ratio valuations just fine over time. Some are going to have some issues, including new regulatory pressures that are likely. And then smaller companies that are value oriented offer very good 3 to 5 year total return potential in our view. Many of these companies, you look at them, they are not the we're going to change the world in the future sexy growth stocks, but they also are trading at discounts to fair market value. And many of them are using technology to enable their kind of old school approach and enhance their profitability and their sales growth in the future. So we're going to get into a whole bunch of texture now, down in the weeds. Let's go to the next slide. Glenn, kick us off on this one. This is actually looking a little rear view mirror to start out with.
Yeah, so this is our asset class return slide that we use pretty much every podcast, and we always like to focus on, at least the column we like to look at is the 2020 column, looking back at last year and kind of getting a recap, for example. And so if you look at that column, let's think back at what transpired last year. Dennis spoke about the volatility in the markets and how obviously March we had our low point, and then we had a pretty strong recovery, but really it amplified or accelerated in the fourth quarter. What's interesting is that as of 9/30, so 3/4 of the year of 2020, there were only 2 of the asset classes were positive, and that was the green area, large cap US stocks, and then the light blue area, fixed income or bonds. And so every other area was still recovering from the March lows. And so what we see now as we look at the end of the year, as Dennis mentioned, the fourth quarter was very strong. We saw some of these other areas really rally and start to really produce. A couple of them you can see at the very top, small cap, we really had a strong rebound at the end of the year, that kind of orange yellow area that was up 20% for the full year. And emerging market stocks, we started to see some really good performance internationally. And some of that, the dollar weakened some as the year progressed. And so you can see emerging markets in kind of that lavender color up almost 19%. Still, US stocks did very well, up over 18%. But you can see that most areas were positive. The areas that still struggled were down at the bottom, the commodities and the REITs. And we're hopeful that as things open up, we'll see more and more performance there that's positive. But I think it really was a tale of really the first 3 quarters and the last quarter. And I think we've really kind of started another cycle. As Dennis mentioned, with the Federal Reserve staying low interest rates, and a lot of central banks around the globe following course, and with the fiscal stimulus we're seeing from their governments, we're gonna be seeing probably more just stimulus on the way potentially as well. And so I think it gets back to, as things open up, we could still have very strong economic conditions that may really help these stocks. But like Dennis also mentioned, the stocks have kind of baked some of this in with the rally we've seen. They kind of looked across the abyss at better days ahead. And the question is, as the economics improve, how will the stock market do?
Yeah, thank you, Glenn. I just had a question from somebody on how to make these larger on the screen, depending on what type of screen you're viewing this on. So just a quick Zoom tutorial here. You should all have a view options at the top tab, and you click on that, and there is a zoom ratio, and you can click on the right-hand side of that, and you can make it just as big as you want. And so I just clicked on 300%, which is way too high. So, but you can certainly make it larger as depending upon the type of device that you are looking at this on. Okay, well, let's go to the next slide. And now we're looking at valuations.
Yeah, so this is a 30,000 foot view of the S&P, and certainly if you look from a valuation perspective on a number of different variables, the S&P does look, a standard deviation plus above normal valuations. Certainly not at the levels we saw at the end of the 90s before the tech crash, but definitely above where we've seen it historically. However, if you kind of peel back the onion a little bit and look at the constituents of the S&P 500, I believe that a lot of this is being driven by some of the larger names within the index. And so, Glenn, I know that we've done a lot of research and peeling back that onion. So turn it over to you to give some more texture around that.
Thanks, Dax. Yeah, why don't we go to the next slide? I think it'll tell that tale. Okay, so here we're looking at the S&P 500, and we're looking at the concentration of the index. We're looking at valuations and also earnings. Let's go to the left side first and look at what Dax is referring to. So here we're looking at the top 10 stocks. Think about, Apple, Microsoft, Amazon, those big names, top 10 constituents of the S&P. And then you have the remaining stocks in gray. So the top 10 is kind of that lime color. And then the S&P 500 just broadly is kind of more the darkest color. So look at the little insert box, and you can see we're looking at relative valuations, the price to earnings ratio. Notice how much higher, it is for these largest constituents of the index, compared to the remaining stocks, which are much lower, and then the S&P kind of in the middle. So we go from 33x all the way down to 22x, or excuse me, 19.7x on the remaining, and the 22 is kind of the average across the whole index. And these are elevated numbers. But as we mentioned, we are in this cycle of opening up, and earnings have been depressed in certain areas. And so while the S&P is a big index, we are wanting to look a little bit deeper under the hood to kind of understand kind of what's driving the index. And if you look at the top right section of the chart, you can see the top 10 names, given the strong market momentum, have become a pretty large part of the index, at least historically, up about 29% of the index. And you kind of see that range over the last number of years. But this isn't a concern like we saw back during the tech bubble. If you think about where earnings didn't support the momentum in the markets, you can see at the bottom right, that the earnings contribution has been very strong, about 24%. So maybe not quite keeping up with the market momentum, but definitely justifying it to a large scale. And so I think when you just think about where we are here, you're thinking these growth names, these mega cap names have really dominated, but they've been largely supported by very strong trends, and they've probably been accentuated, a lot of them, especially the technology names, during the pandemic, because they could continue moving forward when a lot of the more socially distanced areas or more socially dependent areas, better way to say it, were challenged. And so what we'll talk about as we go forward is it may just mean rebalancing slightly away from some of these areas that have been a little hot, but we still want to have access to the strong momentum and growth trends, and maybe look into areas that may benefit a little more as we open up.
Yeah, and there have been a couple of questions that have come in that overlap this area and the prior chart. So one of the questions is around the rebound in earnings. Is it due to inflation or productivity gains and or games? And I think the answer is yes. There are other companies that have lost pricing capability with customers. And so they have to sell at 90 cents on the dollar instead of $1 on the dollar. And so those gains are productivity gains internally. They're getting, it's the digital pivot again that we hear over and over and over again, that companies have raised their ability to increase free cash flow as a result of leaning into automation and digital tools and things of that nature. And we all need to remember, this is a game that has played out many, many times in our history, that every time we go into a tough patch, S&P 500 companies and companies of all stripes try to figure out how to limit their costs, how to cut costs in certain areas. Sometimes it's people, sometimes it's facilities, sometimes it's systems. Hopefully, a lot of times it's marketing, although the marketing experts, including a few of our clients, would say, well, that's when they need to be leaning in to marketing. And so they do get to be more lean. And there's a lot of that going on in the public company space, large and small, frankly. And the pandemic, again, scared people at a very high level back in March, April. So we were on a research call where they were talking about 100 private companies in a portfolio where all 100 went to negative free cash flow in March. And they thought there was no scenario ever where that would happen. Well, that was the induced coma, if you will, the artificial shutdown of the economy. And so now, well over 90% of those companies are back into positive free cash flow and are actually going to beat their original 2020 estimates. Who could have guessed the combination of those two would happen in one single year? So again, I wish I could say there's a one size fits all for answer to that question. There's a lot of texture going on right now.
This is a similar theme to the top 10 versus the rest of S&P. Here we're looking at two constituents. We're looking at the top 100 stocks, or the 20th percentile of the S&P, versus the bottom 100 in terms of size, or the 80th percentile. And it just shows you the dispersion is very wide. It's looking at kind of how far that range is, that gray area, and you can see just how wide it is currently versus historically. And it's really about 2 times as wide. And so it's really saying that the top 100, their valuations are much higher than the bottom 100. And so it really just kind of, once again, tells you it's important kind of where you're positioned within the S&P. Obviously, the ones that are valued more cheaply are ones we're kind of considering, and we're thinking about areas that may benefit as things open up. But once again, it just tells you that you got to look under the hood a little bit.
So let's go to the next slide.
Yeah, and can I just dive into the small cap versus large cap split? I think we told this story a number of times on our various chats, is that within the large cap US sector, it's very heavily weighted towards technology and communication stocks, which are those stay-at-home stocks that it performed well over the past couple of years, and especially through the pandemic relative to other industries. But there is an expectation that as the economy opens up and as there's a normalization of earnings, that some of the other sectors will recover. And those sectors happen to be the sectors that small cap stocks are most leveraged to, such as consumers discretionary, financials, industrials, those sort of names that are more cyclical in nature. So we definitely expect that the small cap names will normalize as we reopen. We're seeing a broader recovery within the market, both in the large and small space, outside of the technology names in the past couple of months, in anticipation for that growth of small cap earnings in 2021.
Good. Next slide. All right, so this is a remarkable chart.
Yeah, I think, Dennis, so many people are focused on just the recovery since the March lows of this past year, 2020. And obviously you can look at the right side of this and just see the strong trajectory up since that down 45% move. But when you kind of step back and you look at more kind of the average stock, this is the Value Line Arithmetic Index, which tries to give an equal representation to the stocks in the index. You can see we've had some volatile periods in the past 3 years, and really we just have started breaking out during this past quarter, above that trend. And so once again, the 3-year period, we've seen volatility, and it could continue like you mentioned earlier, but it's really been more a story about the momentum this past year, really since March.
Yeah, I remember being at a national conference and a very prominent person who was on CNBC all the time 3 years ago, right about the time this chart started, said we ought to be using more indexes that are arithmetic weighted, meaning that they equal weight, like the 500 S&P 500, instead of it being by size, where Apple's the largest holding. It should be equally spread. That would have been a disastrous strategy because you essentially would have not even been above break even here for the last 3 years until recently. All right, next slide. Okay, this is really, again, we're going to talk today about some of the threats out there, but this is pretty interesting. Walk us through this.
Yeah, I think this really speaks, Dennis, to, we are kind of in a new cycle right now, and things, they seem a little hot given how far things have come in a short period of time. But really, once again, if we have the authorities, the central banks supporting the market, and we also have stimulus from the governments, generally those are things that we don't want to fight the Fed. They support the market. And so the trend is we're expecting earnings to improve considerably as we open up. Longer term, we expect the markets and the economy to be more in equilibrium. We know over shorter periods, that's not always the case. But we do know corporate earnings are generally what drives things for the stock market. So if we look at some of these trends in terms of have things really gotten to a blow off top, no, we don't think so yet. There's still signs that things are moving well and the economy's opening up. But we have seen very strong momentum. So that's something we want to continue to check on. There has been flows into mutual funds, particularly equity funds, but it hasn't been as strong as we've seen during past periods like 2000 or 2007 when it was more of a concern. You can see that with the red checks. Really, as you go down, M&A activity, mergers and acquisition, yeah, it's picking up, but it hasn't gotten to a period where it's gotten overly concerning. Now, IPO, when we have these new companies hitting the market from the private world, that is been a little hot. You probably read several that have happened, and that's an area where it is showing some signs. But once again, real interest rates are going to probably low for a while. Earnings are in a good trajectory, and especially in areas that have been depressed. And new stocks making highs, that's something we want to continue to follow that trend. Defensive leadership is something where we might start seeing that if we were getting concerned. And so that would definitely be an area to focus on if we saw staples and kind of the stuff we're always going to buy, the things that are more defensive utilities, if that was leading the charge, then we would be more concerned. And then credit spreads are more of a reflection of the bond market. And it's saying, hey, are things starting to widen out? Are people wanting more yield to justify going into higher yielding bonds or lower credit quality bonds? And we really haven't seen that. Spreads have been tightening. And so everything right now is saying that, we still got some room here, but this is very evolving. And I think we know that there's pitfalls potentially as the economy opens up. I mean, Dax, do you have any other thoughts here? Do you want to highlight on any of these?
Yeah, I think that, you hit exactly right. There are a few threats that may, be put the brakes on the bull market case. And I think one of those is number 6. If you look at upward earnings revisions, we did have a blue wave. And so what does that mean for corporate tax reform in the next couple of years? Will that be a headwind to corporate earnings? And then will we move into a regime within Europe where there's stricter digital taxes as well on some of the bigger names within the index, which again is a threat to that bull market case. And think another thing that we need to focus on that isn't really captured on this checklist is what does sentiment look like out there? And there's a number of indicators that we follow that suggest that sentiment might be getting a little bit out over its skis right now. We're not flashing red, but a lot of people are being more and more positive about what's going on in the market right now. And, given recent history, that it suggests that, we have had a sort of a melt up, as Dennis alluded to earlier, within the market, which makes people more positive about the future and optimistic. But that also can get people a little out in front of their skis. I don't know if Dennis, if you have more to add to that.
No, I think you said it well, that some of this recovery in 2021 is real and is in earnings. The corporate tax reform, will it be all plunked into 2021 if they end up passing something like that, or will it be spread out over several years? Right now, we don't know. And so I think we have to keep an eye on some of that pretty closely.
Yeah, well, I will say, Dax, your comment around sentiment I thought was very key. I think, you think about volatility in the market, what causes volatility? And generally it's when expectations do not align with reality. And so, if you have the expectations that things are going to improve and things are opening up, and all of a sudden maybe we have some pitfalls like you and Dennis highlighted earlier, then that's a problem. And we know your starting point matters as well, valuation wise. And we know the valuations are a little bit elevated right now. They are looking across the abyss at better days ahead. And so if those days don't materialize, or materialize as quickly as the market's expecting, that's when we might have some problems.
To your point, Glenn, I've got a question here. Will Robin Hood rob us all? And I think what that means is the reference that we did in a few chats ago about the 12 million new investors that have come on the scene during the pandemic, many of whom are not experienced. They have been, and it's not just Robin Hood, it's Schwab and Fidelity and a variety of the other platforms for trading. And so there's been some speculation that they have been bidding some things up. And if they suddenly go, oops, I didn't know there was risk in the market, will they bail out, and could that affect things? Latest statistics I've seen seem to indicate that while they are an impact, they're a relatively small impact compared to all the big multi-billion and in some cases multi-trillion dollar institutions looking at stocks. So could it have a little bit of impact from week to week, and particularly on a certain stock that maybe all of them were gung-ho about and suddenly it just drops like it hit an air pocket? Sure. A little harder to see that affect the overall market. I mean, any other comments, Glenn or Dax?
I don't know if I have anything. I think you framed it well. I think, I think investors just, there is that sentiment, that momentum, and I think some people are viewing stocks as the main area right now because they've done so well, and it's challenging to go into other areas, especially bonds. And so I think we just got to recognize as investors that that volatility is going to be with higher risk assets. And I think we always want to spot and look for trends where momentum's getting too frothy or exuberance is kind of getting a little bit ahead of itself. And so those areas we got to continue to look at for sure.
So Glenn, I think that being said, looking forward, you mentioned a few things like sentiment and the frothiness in the market, as well as the trends within fixed income. So here we're going to take just a second to look at some prospective forward-looking returns and what that may mean for globally diversified portfolios.
Yes, Dax. I think when we think about this chart and kind of taking a little more strategic view, looking at kind of short-term, 3 months, 12 months, and then 10 years, going out longer term on the end, we want to start with those major asset classes as our foundation: stocks or equities, bonds or fixed income, and cash, those three at the very top. And we know that right now there's obviously been strong trends with the stocks, and people that are in cash really aren't getting a whole lot. In bonds, they've had a great first half of last year, but now it's more of a yield play, and we know that yields are very low in the fixed income area. So when you think about trying to handicap, where do I want to be positioned right now? that's where it's tough to leave stocks. I mean, I think you always want to think about your risk tolerance and how much you want to have in stocks, given just your risk reward and psychological makeup. But if you look at stocks, I mean, they look pretty good, especially if the economy keeps opening up. But they've done very well, and you want to be aware of the risk, like we described. What's really, really challenging is bonds, given the low yields. It's hard to go strongly into that area, and a lot of people are underweight bonds, but with the caveat that that's the balance in your portfolio when things get rocky. And so that annual cash, just being more stable in cash, which you're not getting hardly anything on your cash investments. But as you go down, there's a lot of areas that are in kind of green that mean they look pretty good, whether they're 4 or they're 5 is really good. And most of those are in the stock area. There are a few exceptions, like if you go down further on bonds, inflation protection looks pretty good, especially as you go further out. The comment earlier from one of the panelists or one of the guests was, is inflation going to be an issue? We do think inflation is likely to start trending up. We don't think it's going to be necessarily excessive, but definitely probably higher than it was last year, and continue moving as we open up, and some of the stimulus impacts it as well. And then as you look more broadly, gold is an area at the bottom that looks pretty good as you go further out, especially if you're concerned about paper currency and just some of the effects of more currency being in circulation and what the central banks are doing. So it's really about trying to pick your spots, trying to look for areas that we feel like, or maybe in that green area that may have a little better opportunities, and trying to maybe minimize some of those areas that are in red that either have lower prospects or could be risk. On a Dax, any other areas you want to highlight here?
I think you thoroughly covered it, and so Dennis, how do you think that positions for globally diversified portfolios and heading into 2021?
Good question. And before I answer that question, there is another Zoom trick that we've mentioned before, and that is if you're seeing the slide and our faces equal weight on the screen, there's a little, you can hover your mouse, your arrow over a little gray bar and move us to the right and shrink all of us to expand the slide. So that way these won't seem to be quite as much of an eye chart exercise. Okay. And so Dax, to your question, let's go to the next slide. And so this is from Strategas, and Strategas we've talked about before in some of our chats. They are very well regarded, highly ranked research outfit. We get daily feeds from them, sometimes hourly, so sometimes every 10 minutes feeds from them on a variety of different subjects. And so this happens to be their asset allocation preference. And at the very top, now this is for a balanced growth and income person. So those of you who are more growth oriented or aggressive growth, there's a little different mix here, but some of the themes remain the same. For example, up at the top, you can see that cash, they have at 9% instead of a normal 2%. So they just have higher cash balances reflecting some of the risks that we've been talking about. In the bond area, as Glenn mentioned, underweight bonds, 27% versus an average 38 for a 60-40 portfolio. And SFG is actually even more underweight and using other kinds of bond substitutes, given the prospects for bonds going forward. But recognizing that ballast issue that Glenn mentioned as well, the downside protection. And then over in the left, the equity piece, 64% versus the all country world index at 60%. And what you'll notice is that the domestic international mix is 37-27 US versus 27 international. And that's actually even a little higher international than we currently have in our growth and income portfolios. But we have definitely been nibbling into the international area yet again. Valuations, some of you saw our live chat and written chats around the valuations. The vaccines are certainly helping on the international front. And so there's a variety of reasons why that allocation makes a lot of sense. And then once you dig a little deeper, you will notice more value in overweight, kind of neutral now on growth, whereas we and they have been a little bit more positive about growth a few years ago, and then underweight some of the core. And so this actually mirrors some of the things that we are doing in our portfolios as well. So let's move to the next slide. So our number 5 is exactly what I just mentioned. International large company will outperform US large company stocks. The trend was already in motion in the fourth quarter of 2020. International stocks roared back and we're actually beating the S&P 500 for the quarter. Again, vaccine rollout, equally positive news overseas as it is in the US. Fair market value is a bit better on a lot of the international. We actually don't mention it here, but international, a lot of the blue chip companies are very dividend oriented. So that's another positive. And then a weak dollar may help widen the stock performance gap in 2021. So let's go to the next one. Yeah, so talk us through the valuation chart we're looking at.
Yeah, so these are trends that we've been following for a while. You know, if you look at international companies versus US companies, very similar companies have had better valuations in the international space. And a lot of that has been due to the fact that the US is sort of the nicest house in a bad neighborhood over the past 5 or 6 years or so with a rising dollar. We've seen most recently some reversal in that trend where the dollar's falling. And so you may see even international money move out of the US into Europe, Japan, emerging Asia, et cetera. So it's a trend that we're going to continue to follow because there are compelling valuations overseas. However, given the uptick in shutdowns across Europe and some of the other developing nations, it might take a while for this trend to play out over the long term. So Dennis, what's the number 6 trend that our convection idea we have this year?
Yeah, and so that gets into the alternative asset area. And, you know, we've been talking a lot about this lately. This trend has been strong through the pandemic. There's lots of niches here: liquid, illiquid, semi-liquid, real estate, private equity, mezzanine, and venture. And for the most part, they have attractive forward-looking returns. I will say that we continue to be very careful in how we select managers. We now have a nice benefit with Hightower as our partner and Mercer doing one of the biggest outfits on the planet, doing a lot of deep dives into due diligence on a lot of these entities. And so we're being selective, but again, a lot of interesting opportunities here. Let's go to the next slide. So this slide, you might have to study for a while to really get it, but what it's essentially doing is looking at the last 20 years for private investments. So these are illiquid private investments, private equity, real estate, whatever. And the foundations and endowments that have done the best over the last 20 years have generally been the ones that have had over 15% in alternative assets. And you can see on the right-hand side, the median return of those pink entities has been 8.1%, whereas the ones that had lower, like under 5%, were 6.5%. And for the full group, 7.1. So having some ability to get additional returns is interesting here. Having more diversification is interesting. And so, again, I think it's something for everybody to kind of take a look at. And SFG is already doing this across a very wide swath of our portfolios. And so here are some of the alternatives we like. Some of them will names you will recognize from your portfolio versus real asset. Infrastructure, particularly with the events of Wednesday of this week, not the storming of the Capitol, but the Georgia election and the blue wave, infrastructure is probably going to get a big boost this year from some major stimulative spending. So that versus real asset should do well. Versus multi-manager, traditional real estate that's been holding up very well in the pandemic-induced recession. High quality real estate, whether it's traditional leverage or opportunistic, we like. Mezzanine lending continues to be a very high conviction item for us. And then on more growth oriented, buffered growth, which there was a question from the audience about power buffer and whether we were going to continue with some of those option strategies. And the answer is yes. We have decided there are enough question marks out there and potential storm clouds that we're going to keep some of that available, and not just in growth oriented accounts, but also growth in income. In fact, growth in income may be the ones that that like to have that more defined outcome. Private equity, multi-sector growth, we're looking at a lot of things there we like. Long short technology, again, this is a very limited grouping of our clients who can afford higher entry points for some of it. But at this stage of the technology cycle, some of the things you heard from Dax, we like the ability of a firm to be able to short some technology stocks even while they're buying on the long side. And then venture capital, healthcare, and technology, some of those we think have accelerated during the pandemic and will continue to do well. So let's go to the next slide. US economy increasing at its fastest pace in 20 years. Again, some of the charts we have been showing you in the written chats in late Q3 and Q4, Goldman Sachs and others have been predicting that this is going to be happening. And they've pushed the prediction out a little bit because of the COVID reoccurrence. But essentially, all they did was move it out a quarter. And so most of the entities that we trust in this area are still looking at US economic levels in general. Not, there's still specific weak points, but in general, getting back to pre-pandemic levels by the third quarter of 2021. And again, I think the good news in the development of the pandemics, and hopefully the coming good news on their rollout of the pandemics, will make that more likely. US economic recovery being very uneven. We've talked about that in a number of our chats. And again, no surprise. We decided not to bore everybody with a lot of those charts and graphs we usually trot out here. And you all know what is doing well and maybe not doing so well in this environment. And this last bullet point, we again point out, we are very hopeful that the new administration and new Congress will consider strongly the fact that job pattern shifting are happening at a faster and faster rate. That is a critical component of our economy. Moving to number 9, unemployment getting gradually better, staying higher than pre-pandemic. Glenn, do you want to talk a little bit about kind of what we're looking at here in terms of recovery?
Yes, Dennis, I think, we saw a bad number today from the job report, but it's still been a strong 7 or 8 months. And so we're not expecting the unemployment rate to get back to the prior low, about 3.5% anytime soon. It may take a couple of years, but we are expecting the economy to continue to open up, and we expect the unemployment rate to drop, and maybe it gets down, to the 5% range as we get towards the end of this year. We do think it'll continue to improve as things open up, but I think it's going to be more gradual from here. And I think we're obviously going to see some people that are going to be impacted more severely and have to look for new areas to find work. So it's definitely a very nuanced recovery like we talked about, and going to be very challenging for some people, but the trend is in the right direction.
And so Dax, we have a question. I don't think it actually has to do with unemployment, but it's a question about cyber currency.
Cyber currency. Yeah, I think that one of the trends that we've seen this year is just an explosion in Bitcoin. I think it's above 35, 36,000. It's up significantly so far year to date. And with that, I think that the future is definitely going towards more cyber-driven currencies, as well as the technology that sits behind them, which is blockchain, that can create a lot of trust within the system. However, I think it's still early in that game, and a lot of the value within some of these cyber currencies is still speculation, not necessarily a use case on using it the way you would use traditional money within the economy. There's certainly a percentage that's being used as such, but it's still heavily speculative within that area. But more and more traditional financial institutions like JP Morgan, Goldman Sachs, et cetera, are exploring cybersecurity. So I think it's still early in that trend, but it's definitely one that's going to play out over the next 5 to 10 years. But it's going to be extremely volatile with the amount of speculation within that market.
Yeah, not for the faint of heart. So we talk about core and explore. Maybe this is hyper explore.
Exactly.
Yeah. So let's go to the next slide. Again, I'm cognizant that we just hit our hour mark and we've still got a little bit to talk about. So China-US tensions remaining at high levels. Again, probably not a surprise to anybody. The new national security advisor for President-elect Biden talked the other day, and it doesn't sound like they're going to be particularly backing off on a lot of China issues. So it's going to continue to be an issue possibly for all of our lifetimes in terms of this new big competitor that we have. Question remains, will it be a serious competitor, or will it be a also ran competitor? There's actually a lot of interesting opinions on that. And again, China is already using vaccines as a tool in its Belt and Road trade superhighway. So they are providing their own developed vaccine to emerging market countries on the Belt and Road. And that will probably curry a lot of favor with those entities going forward. So that just shows how, there's a lot of ways that the United States has developed friends around the world. China is using their own playbook for a lot of this. So geopolitical hotspots, we advise people regularly that 96% of history, politics and geopolitics don't impact the stock market. And so we would say that whilst there are many hotspots, and we are worried about a few of those hotspots, we don't think it's actionable in terms of changing asset allocations. Cybersecurity is also not actionable, but it's pretty big. So Dax, you want to talk about what happened in December?
Yeah, so in December, we, as you mentioned earlier, we're continuing to see a lot of tensions between the China and U.S., and we expect that to continue in the new administration. And a lot of it is being driven by the cyber attacks that we saw, which is, one of the bigger things that we saw is in December, we saw a $3.5 billion cybersecurity firm, which is FireEye, get attacked. And so what does that mean for our relationships with some of these countries that you pointed out moving forward? Are we going to continue to see the U.S. be very strict on China, which I think that is the trend, whether that's going to be a multilateral approach or a unilateral approach? I think we're going to trend more towards the multilateral, but it's definitely a concern with importing Chinese components and other components from the globe that may put some of our security systems at risk on the digital side.
Yep. So let's go to the next slide. And so we just want to finish up with some reminders in the financial planning area. Glenn, you want to kind of just go down through this list quickly so we can wrap up?
Yeah, I think when you're thinking about your financial planning and kind of the goals you have on just those longer term financial planning goals, you always want to think about just kind of your risk profile. You want to think about how am I doing my cash flows? Am I understanding just what I'm trying to accomplish? And here we're just basically saying you've got to really think about how you can move forward. This is a very momentum driven market, And, it's very important how you're positioned and what you're trying to accomplish, because you got to think about both the risk and the return side. And you got to get through this comfortably where you can stay committed and be able to sleep well at night. And so you're just really trying to think about how can I best position myself and think about it from not only the return, but also the ultimate after tax return. And you're always trying to think about just anything I can do. We've talked about Roth conversions where we can get better tax advantage returns going down that path, and just making sure that we stay committed to a long-term strategy, because if you don't stay committed, then you're not going to be successful. And so we've got to find that right risk reward framework and make sure we're adding enough tools, whether it be Roths, whether it be focusing on inflation protection, just to help you get to those goals. And so it's definitely one of the areas we can add the most value in. And Tara Maxwell leads this area for us. And so she's much more knowledgeable about this than I am. So maybe other people have some thoughts, but I appreciate everybody's time. And I'll let Dax or Dennis finish up with this one.
Yeah, so, I think the paranoia now about what future tax rates will be as a result of the blue wave, and also just a result of the pressures of increasing budget deficits. Those are all real issues, but we have to really do things like Roth conversion analysis case by case. And so we've just seen a lot of them where it didn't make sense, or it was not a slam dunk. And then the fourth quarter fumbles, just a reminder that we're seeing a lot of fourth quarter fumbles that are unrelated to anything going on any of the major cable networks. So while you're getting caught up in all the drama, let's make sure that we don't have other fumbles happening that may impact your quality of life going forward. So with that, any final thoughts, Dex or Glenn?
Yeah, I think, one of the most important things on the planning side, and something that I think we've all experienced, that, our life is much more restricted throughout 2020 than it had been previously. So I think it's an important time to reach out and talk to your financial planning team and your advisor to determine, that balance between sleeping well and eating well and living for today versus saving for tomorrow. Because not being able to do a lot of the activities that we were able to do previously really puts into perspective the ability to do so when the economy opens up. And so just that ability to think through some of those scenarios and plan for, a good vacation or an adventure when you get the opportunity, I think it's a good time to do that.
Yeah, I agree, Dax. I think this has been it's been a strong momentum market recently. And I think with that probably comes more volatility and just understanding your risk reward. And then, like you said, longer term results are usually, it's a function of making sure I'm saving enough and making sure that I've got a good strategy and I'm sticking to it. And then let us try to tweak where we can, where we see opportunities and threats, and try to make that as the best, most comfortable experience we can. But it's definitely an interesting time right now.
And with that, we will wind it up. Sorry we weren't able to get to all the questions. Again, you all know where to find us, and we're happy to reach out on some of those additional questions. Reminder that this has been recorded. Will be on our Stearns Financial YouTube channel early next week. And thank you all for participating. And again, happy 2021. Let's stay in touch, and I hope that this year is a much better year than 2020. Thanks, everyone.